Debentures are essentially a debt instrument, a written acknowledgement by a company that it owes a certain sum of money to a holder. Think of it as an IOU issued by a company to raise funds, much like taking out a loan. Unlike shares, holding a debenture does not grant any ownership in the company. Debenture holders are creditors, not owners. Companies issue debentures to the public or institutional investors for a fixed period, promising to pay a predetermined rate of interest on the principal amount. This interest is usually paid periodically, such as annually or semi annually, providing a regular income stream for the investor. At the end of the debenture's term, the principal amount is repaid to the holder. Debentures can be secured or unsecured. Secured debentures are backed by specific assets of the company acting as collateral. If the company defaults, the debenture holders have a claim on those assets. Unsecured debentures, also known as naked debentures, rely solely on the company's creditworthiness and reputation. Due to the higher risk, unsecured debentures typically offer a higher interest rate. Furthermore, debentures can be convertible or non convertible. Convertible debentures give the holders the option to convert them into equity shares of the issuing company at a predetermined ratio and price after a specific period. Non convertible debentures, on the other hand, remain as debt instruments until maturity. Debentures have a fixed maturity date, indicating when the principal amount will be repaid. Some debentures, known as irredeemable or perpetual debentures, do not have a fixed maturity date, and the company continues to pay interest indefinitely. The face value of a debenture is the principal amount stated on the certificate, and the market value can fluctuate based on interest rates and the company's financial health. Debenture holders do not typically have voting rights in the company's general meeting, unlike shareholders. Debentures are usually transferable and can be traded on stock exchanges, providing liquidity to investors. The issuance and trading of debentures in India are regulated by SEBI. Investing in debentures offers a relatively stable and predictable return through fixed interest payments, making them attractive to risk averse investors. However, they carry risks such as default risk, meaning the company's inability to pay, interest rate risk, meaning changes in market interest rate affecting their value, and liquidity risk, meaning difficulty in selling them before maturity. Companies find debentures a useful tool for raising long term capital without diluting the ownership of the existing shareholders.